First of all, tell us why you know anything about Bitcoin.
Hello, everybody. I'm JJ, and I believe 2009, maybe it was a year after that. I don't know exactly, but the first Bitcoin I actually ever used was a physical Bitcoin, which is strange. The Cassatius coins were something that were passed around when I was on Free Talk Live, and it was something the co-host of the show got, and it was a coin, and you ripped off this little piece, and it had the private key right on the coin itself, and then you would redeem that, and then the coin itself would be useless. I mean, it would be a trinket. But more recently, for the last 2.5 years, I've been doing a podcast called Neocash Radio with my co-host, Dr. Darren Tapp, a Mass PhD, and we've been covering Bitcoin since just before the Mt. Gox, crash. And so it's something that every week we look into and we do a lot of research on. Darren is the kind of math guy who gets into the actual cryptography and the math behind it, so he educates me on that. But more to the point, I guess, is that this podcast has definitely kept me up with all that's going on with Bitcoin, the altcoins, the different markets. And as well, we cover global economics, macroeconomics, a lot of monetary policy across the world, and seeing how these things sort of overlap and interlock, and getting that big picture perspective is something that I really value and share with my listeners. So I do think I am a Bitcoin expert. I'm the guy that will program the actual Bitcoin code, but I make it my job to tell people about Bitcoin and explain it in terms that they can understand, and that's what I do.
All right. So my name is Andrew Curioso. Feedback. There we go. Thanks.
Yeah.
All right.
No, he needs it to get into the TV.
So speaking to the TV audience right now, I am a software engineer predominantly, also an author and a conference speaker. I am the Chief Technology Officer of GoCoin, which is one of the leaders in the Bitcoin payment processing space. And we recently merged with Ziftr, which is actually a company out of Milford, New Hampshire, which is the company I started at, which is a company that allows merchants to offer a unified checkout that lets the customer choose whether they want to pay in Bitcoin, credit cards, or loyalty points rewards. I am a computer scientist and co-creator of Ziftr Coin, which is an altcoin, or in other words, an alternative to Bitcoin. But GoCoin accepts Ziftr Coin, Bitcoin, Dogecoin, and Litecoin, which are all coins that are built upon the blockchain ecosystem. And I have I hope to bring to the table the background in software engineering and the business side of Bitcoin to help out. Unlike JJ, I actually started Bitcoin because I was in the financial and e-commerce space and saw the potential of the currency and what it can do for us in the future.
How do you get a Bitcoin, and also how do you become a miner? Where do these miners come from? Do you have to sign up or something? So, you want to start with that? Okay.
Yeah, I'm going to start with just how to get a Bitcoin. And before I was like, I didn't want to talk about the brands and pimp some website over another one. But really simply, there's Coinbase is an example. BitPay is another one. There are plenty of these. You can go to Coinbase, sign up for an account, just create your account, and then you can link that to your bank account and buy Bitcoin whenever you want. And then you can hold it there on the Coinbase. You can send it to your own wallet. You can spend it. And Coinbase is linked up with a lot of merchants. And I'm sure he can talk to you more about how else you can do it. But it's really that simple. It's as simple as going and starting an account. Now, here's the thing, is that the know your customer thing, as he was talking about, you will need to give some paperwork, some information to them. And if you want to, the more and more Bitcoin you want to spend or buy, or hold in their accounts, the more information you need to give them. So it's very much like a bank account at that point. What I had talked about earlier was just find someone. The easiest, the lowest barrier of entry is like, let's say there's Bitcoin meetups that happen. There's one that happens in Manchester, and these people meet up for the sole purpose of getting together, talking about Bitcoin, but also exchanging it. So at the meetup, there are people with Federal Reserve notes, dollars, and there are people with Bitcoins, and exchange happens right there. So that's another way of getting it. I don't have a smartphone. I'm a technologist. But you know what? Not having a smartphone, and just a side note, not having a smartphone allows me to focus more on what I'm doing in the moment and pay more attention to the people around me. So that's part of the reason I don't have it, because I think we're losing that. I think we're too lost in our smartphones, and we fail to see that we're surrounded by amazing people at any point in time. So I'll give it to Andrew, and he could quickly touch on this point again, and then the miner thing too.
How do you become a miner? 49er.
Well, so I get the tough side of the question. So becoming a miner is a lot more complicated question than it used to be. Nowadays, so to become a miner, you need a computer or a ASIC, what's called it's a dedicated chip just for solving these equations that we talked about. There is a significant barrier of entry right now to becoming a miner, but that's actually okay because there are enough people who are willing to do it to make sure that the network stays secure. So just hypothetically, if we have some people who are very adventurous in the crowd, what you do to become a miner is you build a computer or you buy one of these chips that solve the blocks, that take the transactions, try to put them together in a block. And then you hope that you solve enough blocks to actually get some Bitcoin, which right now you would need many, many computers to try to actually solve a block. There are people out there with thousands of computers in what's called mining facilities, which are exactly what they sound like. So if you don't want to compete against those people, you can actually go in what's called a pool. So what a pool is, it's hundreds of people, thousands of people, tens of people, depending, who decide, hey, I know that solving a block myself would be a sheer stroke of luck. So I'm going to get a pool with all these other miners, and if I solve a block, I promise to share it with everybody else, as long as they promise to share the reward with everybody else if they solve it. So that's a way to get into mining without having the large, 100+ computer data centers, is to get in a pool, and essentially you're a bunch of people, just like a lottery pool. Everybody goes in on the ticket, and if you win, everybody gets it. Kind of the same concept, and then you can get coins. Alternatively, you can use a altcoin like some of the other coins that are not Bitcoin, have a lot less competition for solving blocks, and you may get a little bit luckier doing that.
Okay, so let's say I'm with IBM and I have access to a Watson computer, or maybe a couple of them. Can I set up the biggest mining facility, and would I deploy that as thousands of virtual machines, or one big machine that solves it really, really fast?
So you have a fundamental problem there. First, you move your Watson to China, or someplace where the electricity costs less than it does here, because running a computer that powerful requires a lot of electricity. And that's actually, it sounds silly, but the cost of electricity actually factors in a lot in terms of whether or not mining is profitable or not. So yeah, if you have access to a supercomputer, you can potentially make some money mining. It's... I'm going to stop short of recommending you do that. I don't know if you have a supercomputer, but I'm going to stop short of that.
it makes more sense for IBM to sell that supercomputer and buy a lot of ASICs, to be honest. ASIC, just real quick, application-specific integrated circuit. So it only does one thing, but it does it really, really efficiently. And that's why ASICs have taken over the mining market, because they're using those watts, every bit of electricity, to create a solution the most efficient way it can. And you can't use those for anything else. That's all you can do with them is do these hash functions for that specific coin. Now, some of the altcoins use different functions, and so you wouldn't be able to use the ASICs on those. But once again, just get back to what Andrew was talking about, the cost of electricity is huge, and you have miners that when Bitcoin was $1,000, yes, it was very profitable to mine, but when it dropped down to 250, they turned off their miners because it wasn't profitable for them to mine. So as it rises and falls, you're going to have people turning on and off their miners, and then the network is going to see more hash rate or less hash rate.
How about the votes? Like, I could have a lot of votes in the network.
I'll answer that question, but I want to make a quick public service announcement first. There are some companies out there that will rent to you hashing power, they call it, which is essentially time on their computer to do hashing. I'm not going to pass judgment on any individual companies, although there have been a few bad players in the past. But all I'm saying is if you want to get into mining and you find a company that says, oh, just pay us $10 a month and we'll get you into mining, just ask yourself the question, if they had these machines capable of solving blocks and they could run it, why wouldn't they do it themselves instead of renting it out to you? But to answer your question, so you have all these miners all across the world racing to solve these transactions into a block. When they solve the block, they will broadcast it to all their peers, as they're called, everybody they know, and then everybody they know will broadcast it to everybody they know, and so on and so forth. Eventually, you'll run into a situation where two miners solve a block at the same time. So what happens? Well, what ends up happening in that situation is you have half the peers on the network thinking that this miner got the block, half the peers on the network thinking this other miner got the block. So what it does is it kind of goes to a tie-breaking round, so to speak, is you wait until the next block, and then the miner who solves the next block will decide which block is the previous block that it agrees with.
Is this like the coin flipping they did in Iowa?
No.
Oh, okay.
Much less bias.
All right.
So basically what happened, this tie can go on indefinitely. It's called a fork. It's called a fork when two groups of the network have a different opinion on what the
I think maybe
proper
we're
blockchain
getting a
is.
little too far in the weeds with forking,
Basically all we need to know though is that it might take a few blocks before the network agrees on a winner, which is why if you download your wallet and you see a number called confirmations, that number is actually how many blocks have been put onto the network since your transaction went through. So if it says your transaction has 10 confirmations, that means there's been 10 blocks since your transaction was put on the network. So that's why some merchants, some people who accept Bitcoin might say, hey, I'm only going to consider this if there's 3 confirmations, because they know that the first confirmation there could have been a tie.
Well, like any new technology, people are going to be a little hesitant to jump in on this. But earlier you said that a full-blown program could be on his computer. And I'm not the smartest guy in the world and way far from it, but people who can program can figure out how to get into his computer because they can get into NASA's computer and everybody else's, and I'm sure his isn't as secure as those. So what makes me get those trust issues that you mentioned earlier, what makes me feel good about that?
Well, to flip that analogy, if I have my wallet sitting in my house, there are people who have bricks, and those people can break my window and come in the house and grab my wallet and my TV and whatnot. So if you're keeping coins on, if you're keeping your wallet on your computer, you need to take reasonable precautions to make sure your computer is safe. But with that said, that person only has one copy. Thousands of people have the full copy of the network, so all they could do, the most damage they could do, is steal your wallet, which you need to be responsible and know that, you don't usually keep your life savings in your house. You usually keep it in a bank. And there are equivalents in the cryptocurrency community of banks. And there are ways to secure your coins so that if somebody does hack your computer, they don't have your life savings.
All right. Got another question? Right here.
Not always. Not in the default Bitcoin settings.
I'm interested in how the value of a Bitcoin can go up and can go down. I guess that's the main thing. I'm thinking of people in countries where their currency goes up and down and maybe controlled by the government. Would they use a Bitcoin to get around that? But if I had Bitcoins, why does it go up and down? And will they make more Bitcoins, or will we use smaller fractions of a Bitcoin?
Well, it's the exact same reason a stock goes up and down. A stock goes up and down because other people think that it's going to go up or think that it's going to go down, and they buy some in speculation. As the speculation dies down and people start to use it on day-to-day transactions more, it will stabilize, and I think we're already seeing a little bit of that.
Or the analogy of gold. The price, you use gold to buy stuff, but sometimes it goes up and sometimes it goes down. And
Yeah, I agree. It's definitely more volatile than some other forms of payment you can deal with at the moment. But that's just because, it's like, I liken where we were like 10 months ago to the California gold rush. But, as it did in California, it's calming down a bit and we'll end up with something stable pretty soon.
And she asked about, are we going to, run out, we're going to use up all the Bitcoin, which is a semi-complicated question, isn't it?
So you know how a dollar can be broken up into cents, 100 cents to a dollar? There are 100,000 what's called Satoshi to a Bitcoin. So that's why you see sometimes when people are pricing something in Bitcoin, they'll use like micro Bitcoin as their actual currency. So each unit of Bitcoin can be broken up 100,000 ways, so 100,000 cents. So, well, a individual Bitcoin might be too expensive for somebody to pay for your sandwich with. You can pay for your sandwich with 0.001 Bitcoin, which is about $3, I would guess, right about now. So you don't have to pay for everything in whole Bitcoins.
Is there an estimate of the current estimate of the Bitcoin economy, and does the IRS have access to the ledger?
Yes and yes. The IRS has access to the ledger. They don't necessarily have access to who. The ledger does not store names. It just stores transactions. So when you ask somebody for money, you're not asking, JJ's not asking me, hey, can you send a quarter of a Bitcoin to JJ? He's asking me, can you send a quarter of a Bitcoin to AEF12035, this big long address, which if JJ's smart, can't be tracked back to me. But, the fallacy that Bitcoin is anonymous is actually just that. It's a fallacy in that it's just like anything else. If you, at some point, tie your anonymous address to your real name somehow, it can be traced back to you. But that's not inherent to the blockchain. That's just human nature and human behavior. Oh, I don't know. Do you know the market cap off the top of your head? 5 billion. 5 billion, roughly.
So that's the total current dollar value of all Bitcoin in circulation?
Yeah, and I should point out that, as I mentioned earlier, the number of total new Bitcoins is limited by the math, by the network. And likewise, just like in real currency where sometimes you lose a quarter in the couch cushions and you can't find it, there are also Bitcoins every day that are being lost in couch cushions that are never going to be spent. So they're essentially taken out of circulation because somebody, lost them. just like the quarter in the couch seat.
So the total number of Bitcoins is 21 million, divisible up to 8 decimal places, and you can pretty much, at that point, as the value increases, you just move the decimal down. So Bitcoin is, if the market cap, let's say 21 million Bitcoins were out in circulation, and as he said, some of them were lost, but let's say they're valued at $10,000 a Bitcoin, you just keep moving the decimal down to buy your cup of coffee. That's really how it works out. It's meant to be scalable, and eventually, some people actually start using smaller amounts, let's say 0.001, and that's like the starting point. Instead of talking about a full Bitcoin, they're not going to refer to a full Bitcoin anymore. They're going to refer to a thousandth or a millibit Bitcoin, right? So it's very, very scalable, very divisible, and adaptable.
All right, question? I have something I want to talk about, actually, or get you guys to talk about, which is not Bitcoin itself, but blockchain and how it can be used in other ways, and the value of it, which is something that our neighbors in Vermont officially looked at, and a bunch of countries are, and there was this gentleman here was at a presentation or a discussion up in this summer up in Bretton Woods. So, what do you want to talk about?
Basically, blockchain is a great way to distribute ownership, to tell people who owns this. Okay, so you could use the blockchain, that part of this technology, and let's say you moved it to some other business or some other thing that wasn't Bitcoin related at all. Like NASDAQ, for example, is looking at using the blockchain for their trading software. And so right now what happens in NASDAQ is that you go and make a trade and you buy something on NASDAQ, and then in the back end, some lawyer in the back room is moving it on a spreadsheet from one column to another with every single trade. A lawyer, a high-paid person, is moving it on a spreadsheet from one column to another. Now, Bitcoin can solve that. Bitcoin can make it so that there isn't a person moving it from one spreadsheet to another. In fact, it's all happening inside the protocol instantly. Because the protocol, the blockchain software, or that part of this, it verifies that, yes, you have this, and you can put it in this, you can send it to whomever address you want. So that's the key thing. It verifies that you own it, and then it moves it to the next owner. And that's what the blockchain technology is really, really good at, is basically solving the issue of who owns it and how much. And that's it. And that is extremely powerful for any sort of business that involves moving ownership, whether it's the title of a house, whether it's a stock number of stocks you have, it's a car VIN number, could be, the address could be a car VIN number. And this VIN number here, I mean, I could own that VIN number. You know what I'm saying? Like, it just moves into my account. And then when I sell it to someone else, I move that VIN number into another account, right? So like, that's what the blockchain really solves, is who owns it. And that's really it. Because the blockchain doesn't care about who doesn't have Bitcoin. You know what I'm saying? The blockchain doesn't record the zeros. If you don't have Bitcoin in a wallet address, it doesn't care. It only cares about when you have an actual number in that address. There you go.
So really, and I know there's a question over there. So think about, everybody watches, either watches TV or reads mystery novels or whatnot, and you always hear about somebody keeping a second copy of the books, and that's where all their off-the-book transactions happen. That can't happen on the blockchain. When you make a blockchain transaction, you are guaranteeing two things. One is you're guaranteeing that you have the key to actually spend what was in that transaction. And when I say the key, I'm not thinking like a key to a safety deposit box like I used as an analogy. I'm talking a key that is many, many bits long. Think of it like think of it thousands and thousands of times more detailed and more difficult to copy than a safety deposit box key. So you're guaranteeing that one, you were allowed to spend that money, and two, that you can't give that money to anybody else. Once it's spent, it's spent. So you can't promise two people I'm going to spend the same, give the same car to. So with that, blockchain is an incredible tool for having, you know, a immutable ledger of things like stock purchases, public sales,
Land ownership.
land ownership. Even there are a few alternatives to Bitcoin that have even tried to put contracts on the blockchain, and using the blockchain as a way to prove, yes, this person agreed to this contract, and yes, the conditions of this contract were met. So the applications are, you know, have the potential to upheave tons of industries like banking and stock markets and things like that have been entrenched for, you know, centuries, decades at least, that have been doing that we've been relying on them to do their job right. The blockchain takes, you know, takes it so we don't have to rely on them, we don't have to trust them, we can see they're doing their job right.
So one of the places that's definitely looking at is the country of Guatemala, which, like many poor countries, does not have good institutions for guaranteeing that legal records are kept properly. So that the example you hear is you go down, you buy a piece of land, you go register at town hall, you come back here later, and you know the local Cabo has changed the paper, and now he owns it. If it was done on blockchain, then the local people couldn't do it. It would be guaranteed. There are a number of places that are looking into that.
And one final thing is that, like, let's say you have a charity that fundraises, and this charity is like, oh, we need to raise X amount of value by X date. Well, with Bitcoin and the blockchain technology, you can go and look at their address and see exactly how many Bitcoin they've gotten. Now, you don't know exactly who it came from unless someone has associated that address with their name and their person. But you could see exactly how much they've gotten, so they can't lie to you and say, well, you know, we haven't gotten nearly half of it, and like some of it's disappeared. You know, and that's part of what blockchain does, is it takes out the human error element. It takes out negligence, it takes out maliciousness, and it takes out forgetfulness. You know, people make mistakes, and some of them are honest mistakes, and they're decent people. But this technology removes that factor. The transaction either goes through, or it's found to be a fraud, right? The network either says, yes, this can happen, and it will happen in due time, depending on circumstances, or no, it can't happen. This transaction just is impossible. You don't have that to send. Thank you all so much for showing up to listen to this. I know there's a lot of difficult things to understand. Really, it comes down to doing your own research. If you're interested in this, there are so many resources out there. I'm not going to give you anyone. I'm going to let you find it on your own terms, but you should look for it. Just Google search Bitcoin, how to start out, how to make a wallet. There are videos. Everything you could want is out there. It's just waiting for you to find it.
So let's thank our panelists, JJ and Andrew.